session panels of this year's conference, and we are unfortunately missing one of our panelists this morning. He will be here. He was delayed. This is Raj Cohen, who was flying in from New York City. He was delayed. His flight was diverted to Dulles. So when he arrives, we will hear from him, but we have had to rearrange the order of the speakers this morning a bit to accommodate his late arrival. The financial crisis of 2007-2008 is widely regarded as the worst since the Great Depression. Congress responded by adopting, among other measures, the Wall Street Reform and Consumer Protection Act of 2010, better known as the Dodd-Frank Act. The Act is a massive and complex regulatory effort to guard against systemic risk in the financial markets. Our panel this morning will unpack its primary features, discuss whether the Act is sound regulatory policy, debate the extent to which it will prevent future crises in the financial markets, and even challenge its foundational premise that there are some private institutions that are too big to fail. As always, the Federalist Society has assembled a highly distinguished panel of experts this morning who are uniquely qualified to address this subject. First up this morning to give us an overview of the features of the Dodd-Frank Act, and then who will come in later in the discussion with a critique of Dodd-Frank is Peter Wallison. He is seated to my left here. He holds the Arthur Burns Chair in Financial Policy Studies at the American Enterprise Institute and is co-director of AEI's program on financial policy studies. Before joining AEI, he practiced banking, corporate, and financial law at Gibson, Dunn & Crutcher here in Washington, D.C. During the Reagan administration, Mr. Wallison served as general counsel at the Treasury Department, where he played a key role in the proposals for deregulation of the financial services industry. He later served in the Reagan White House as counsel to the president. He is author of many books and countless articles on economic policy, the financial markets, and politics. Mr. Wallison earned his law degree at Harvard. Second in our order this morning will be Dean Baker, and he is seated on my far right here, perhaps anomalously here. Dean Baker is co-director of the Center for Economic Policy Research here in Washington, D.C. He is the author of several books, most recently, The End of Loser Liberalism, Making Markets Progressive, which challenges the conventional narrative that the central point of dispute between liberals and conservatives is that liberals want government intervention to bring about outcomes that they consider fair, while conservatives want to leave things to the markets. He argues that progressives should focus their efforts on restructuring markets so that more income flows to the working population instead of a small elite. Mr. Baker has a PhD in economics from the University of Michigan. Next up will be Paul Singer. He is seated to my immediate right here. He is the founder and general partner of Elliott Associates, a New York-based trading partnership with some $17 billion in assets under management. The New York Times has called him one of the most revered hedge fund managers on Wall Street. Mr. Singer has said that one of the reasons for his firm's success is that we try to be very respectful of the unpredictability of markets. We try at all times to at least assume that the world is not being properly run. Whether by virtue of that principle or not, in 2006 and early 2007, Mr. Singer was warning of the coming systemic financial crisis. He has been a prominent critic of the Federal Reserve's handling of the crisis, as well as the congressional response, and Dodd-Frank in particular. Mr. Singer also has a law degree from Harvard. And our last speaker this morning, as I've indicated, Mr. Cohen, when he arrives, he will be worth waiting for. Raj Cohen is a partner and senior chairman of the Sullivan and Cromwell law firm in New York City, where his practice is focused on corporate governance, acquisition, regulatory, and securities laws matters for United States and foreign financial institutions. Mr. Cohen played a critical role in most of the major bank acquisitions and government-sponsored and capital-raising efforts during the recent financial crisis. He has a vast knowledge of the banking sector and its regulatory overlay. His influence over Wall Street has been described as both legendary and pervasive. He has been called the Dean of Wall Street lawyers, the trauma surgeon of Wall Street, and a trusted advisor who brings both intellectual firepower and a calm humanity and integrity to the most urgent and complex systemic problems of his client financial institutions. Mr. Cohen also has a law degree from Harvard. With that, we'll start with an overview from Mr. Wallison and then proceed with our discussion.
Thank you, Your Honor. This legislation, as Diane Sykes suggested, is enormous in its scope and range. I will try to summarize it in about a minute and a half, mostly for the purpose of giving you a little review of what you probably read in the papers but may not be practicing if you're lawyers every day of the week. This legislation was framed by the Treasury Department shortly after the Obama administration came into office to fill holes in the financial regulatory system revealed, they thought, by the financial crisis. It was ultimately passed on July 21, 2010. We've now passed the first year of this legislation being in effect. Now, one of the remarkable things about it was about 2,300 pages, and there are, as some estimates put it, and it's really hard to get the estimates all together because it is so difficult to find all these things in the bill. There are about 270 regulations that have to be made by government agencies in order to implement this legislation. Now, the major provisions are a Financial Stability Oversight Council, which you'll hear about today, called the FSOC, Financial Stability Oversight Council. And the power of the FSOC is considerable, but the most important one, and this agency is made up of all of the federal financial regulators. The power is considerable, but the most important thing it can do is to designate certain institutions as systemically important financial institutions, known as SIFIs, to those of us who are unfortunate enough to have to work in this area. SIFIs, you'll hear about those today. And once they are designated, once an institution is designated as a SIFI, it is then turned over to the tender mercies of the Federal Reserve for what the Act calls stringent regulation. SIFIs are not only banks and bank holding companies, but they can also be insurance companies, insurance holding companies, hedge funds, other kinds of financial institutions like finance companies and so forth. Whatever it is that the FSOC believes is a SIFI, systemically important, because if it fails, it will cause some kind of systemic breakdown. That's why they're called systemically important. The Act also contains an orderly resolution or liquidation process run by the FDIC, supposed to be the same general kind of thing that the FDIC does for banks, large and small, but this would apply to the SIFIs and also to any other financial institution which at the time, if it appears to be failing, might, in the view of the FDIC, the Secretary of the Treasury, and the Fed, cause a systemic breakdown if it fails. So, orderly resolution process, important to remember because that has a lot to do with the question of whether something is too big to fail. There's also in the Act an elimination of proprietary trading by bank-related entities, which isn't just a bank, but bank holding companies and subsidiaries of banks. They can no longer engage, this is the so-called VOCA rule, they can no longer engage under the Act in what is called proprietary trading. It's difficult to define, but the regulators are working on it now. And there is also a new regulation that puts all kinds of derivatives under control of the commodity, it's the CFTC, the Commodity Futures Trading Commission, and they now have the power to regulate all kinds of derivatives, including credit default swaps, and I think we'll have a chance to talk a little bit about credit default swaps in the discussion. And finally, and this isn't all, but this is certainly one of the most important things, the Act creates something called the Consumer Financial Protection Bureau. It's a bureau of the Federal Reserve, and it has taken over all of the consumer protection powers that were previously held by the banking regulators and now applies all of those laws to any transaction between any kind of entity and a consumer, a financial consumer. So it's a very powerful agency with a range all the way from the biggest banks to the smallest check-cashing company on the corner of a little town. Okay, I think that's my summary of the Dodd-Frank Act.
Thank you. Mr. Baker.
Please.
Please.
Okay, this is unusual company for me. I guess I'm going to take home my Federalist Society thing. By the way, since Mr. Singer gets credit for having warned of the financial crisis since '06, I want to say I want credit. I was warning of the housing bubble since '02, so I was not asleep at the wheel on that one. I'm going to take a critical view of the Dodd-Frank legislation, arguing perhaps, well, I shouldn't say perhaps, arguing that really it didn't go far enough, that I will want to see stronger measures, that we do have a problem with too big to fail institutions, and the way to deal with them is not to have a oversight panel. The way to deal with them is to break them up. And I would actually argue, you know, if people believe in the market, you should want this, because the whole point, and I'll go through this argument here, that if you have too big to fail institutions, they're in effect operating with a government subsidy, and I just don't understand why people believe in the market would want that. And in terms of the Volcker rule, again, I would argue for something stronger. I mean, to my mind, I would like Glass-Steagall type legislation returned. Again, the argument here seems to me a market one, that we have institutions, banks that are operating with government-insured deposits, which maybe you don't like government insurance, but it's there. So if you have government insurance deposits, it seems to me that the government has a right to say what you're going to do with your money. So I would actually argue for something stronger than that, Glass-Steagall type regulation as a strict separation between institutions that have government-insured deposits and institutions that engage in other types of financial activities. And just, you know, quickly, I mean, again, I'll come back to, you know, defining too big to fail in a second. But, you know, the idea that you could have non-bank financial institutions that, you know, can be too big to fail, I mean, that we could argue whether it's true or not, but it shouldn't be that strange. It wasn't that long ago we saw AIG collapse. And to go a little further back, but not exactly ancient history, many of you probably remember long-term capital that, you know, Alan Greenspan, maybe he was wrong to think that, but he thought it was necessary for the Federal Reserve Board to get involved in its unraveling. We should not want to see that. I mean, if you believe in the market, you should not want to see that, and that, again, was not a bank. So, you know, again, we could be wrong about that, but I think it shouldn't be implausible that we have non-bank financial institutions that are too big to fail. Okay, well, first off, well, what's the evidence that we have too big to fail financial institutions? Well, one thing you could do, and I did a couple papers on this a couple years back, that just look at their cost of funds. And if you look at the largest financial institutions, they have substantially lower cost of funds than the rest of the banking system. And it was pretty hard to, I did the last paper, I think it was '09. It was pretty hard to argue. The largest financial institutions, of course, include Citigroup and Bank of America. If you're going to do this in terms of their soundness and safety, I think you'd be hard-pressed to argue that this group, the largest banks, were sounder and safer than the bulk of the banking system, certainly not at that time. Also, if you look at the pattern through time, you find exactly what you'd expect to find, that the spread, the gap between the cost of funds for the largest banks and the rest of the banking system exploded during the financial crisis, which is what you expect. Spreads collapse during normal times. When you have a period where, you know, there is a great deal of uncertainty, as obviously it was in '08, '09, then those spreads widen. They got as high as 0.8, 0.9% and percentage points. And that's exactly what you'd expect. Now, again, you could say that people thought that these were sounder banks simply because they were in fact sounder banks. But again, I think when Citigroup, by most accounts, was bankrupt, we were giving them a lot of money if they weren't bankrupt. And again, Bank of America, I think you'd be pretty hard-pressed to make the case that, you know, they had lower cost of funds because they were inherently sounder, more profitable institutions. I think that would not hold water. Now, there was a study done by the Bank of England. It was more careful. They did look at their profitability, their revenue growth, other factors like that. Found pretty much the same thing. They found subsidies on the order of 0.5, 0.6 percentage points. I know of another study looked at, is an interesting way to approach it, the premium that they paid for mergers, in effect asking what's it worth to a bank to become too big to fail, to in effect get this subsidy. Again, came up with a similar sort of conclusion, somewhere in the order of half, 0.6 of a percentage point subsidy in terms of lower interest payments. So what do you make from that? Well, at least my takeaway is that we're giving a very large subsidy to the biggest financial institutions. You know, if you look at a half percentage point subsidy, if we take the very biggest, JP Morgan or Bank of America with around $2 trillion in assets, that comes to about $10 billion a year in subsidies. Why would you want to do that? What is the policy that, we're pursuing that is somehow made good by giving very large subsidies to the shareholders, to the top executives, to the top employees of these very large institutions. So if it's the case that we actually have too big to fail banks, it's very hard for me to see at least what public policy goal we're pursuing by allowing that. One last point, is just anecdotal, but I kind of like it. Most of you probably have heard of Simon Johnson, the former chief economist at the IMF, who started taking this on his crusade. He wrote a very good book, 13 Bankers. I'm not getting paid to plug it, but it's a good book. But he makes a point, he talks to a lot of audiences, and he always says that he goes around and he asks people, how many of you think Goldman Sachs would be allowed to fail? Which is a good question. How many of you think Goldman Sachs would be allowed to fail? Okay, we got a few. All right, good. Okay, well, fair enough. He always asks that question, usually to business audiences, and his claim, I haven't tried to verify it, is almost no one ever raises their hand. Again, that's the point. If people do not believe that a bank will be allowed to fail, if actors in financial markets don't believe that a bank will be allowed to fail, then they're willing to lend money to them at a lower interest rate than if they think they're taking the same risk as with any other institution. That's the point. If actors in financial markets believe that, then in effect it's a subsidy to those banks. Okay, so what would be the advantage of allowing too big to fail banks? Sometimes people argue that they're economies of scale. There's a lot of research in the banking industry, how large you have to be to get economies of scale. Most of it you get pretty much every available economy of scale around 50 billion. 50 billion in assets, some as high as 100 billion. In any case, this is way below whatever estimates there might be. They're way below the size of our largest banks. So 50, 100 billion. If you look at, again, at the largest banks, they're at 2 trillion. You get down to the former investment banks, Goldman Sachs, Morgan Stanley. They're 700, 800 billion. I haven't looked at them lately, somewhere around there. They're way larger than any plausible measure of how large you would have to be to achieve all economies of scale. So obviously we want banks to be large enough to get economies of scale. There's no plausible story that you have to have 1 trillion in assets, 2 trillion in assets to get that. Now there is an argument, and I've heard people from the Obama administration actually make this, that if it were the case that we broke up the large banks, then we would be dominated by foreign banks, that we would have the German, the Swiss, Japanese banks, whoever it might be, coming in and taking market share. And in effect, that sort of argument is saying that those banks would be taking advantage of their too big to fail subsidies to basically undercut our banks. And it's kind of an interesting argument because I sort of had me scratching my head. If that's true, so what? Okay, so in other words, let's imagine for a moment that the German government's stupid, the Japanese government's stupid. They're willing to give subsidies to their large banks. And as a result of that, they're going to outcompete our large banks. And, when we go to the bank, it's going to be a bank that's owned by a Japanese firm. So what? What's wrong with that? We buy our cars from Japan. We buy our clothes from China. What's wrong, if our financial services are provided by foreign banks? What's the problem with that? In effect, what that's saying is that those foreign governments are taking the risk if these banks end up doing irresponsible things. They're the ones who are going to be on the line. Have people heard of Iceland? Do we want to be like Iceland? Does that make sense? We want to give subsidies to our banks so they can compete internationally, and then if things go badly, we're stuck with the tab? That really doesn't make sense to me. So, I question how much that's really true, but, let's say that their worst case scenario, it's not a bad scenario to me, their worst case scenario pans out. It ends up that, the foreign-owned banks end up dominating our system. I don't really see the downside to that. If they're foolish enough to do that and they want to underwrite the risk of large banks, I just really can't see the downside. All right, well, let's say for the moment we have too big to fail banks, and we do decide that is a problem. How do you deal with it? Well, there are different things that have been proposed. One is the living will. I think Peter's an advocate of that. I don't want to put words in your mouth. You decide that. But some people have advocated this idea that there'd be a living will, that this would be, financial institutions would keep in effect a sort of instruction set of how to break themselves up in the event that they fail. I think this is really problematic. One, when you talk about a large financial institution, a large diverse financial institution, a living will is going to be a really long, complicated document. Second, things change. Maybe the living will makes good sense in November of 2011, but it might not make a lot of sense in November 2013. Another part of the story is that I think it's probably a safe bet, well, I'll just say I think it's a safe bet, that whatever it is that causes these financial institutions actually to be in a situation where they're about to fail is an unanticipated event. Otherwise, they wouldn't be there. So in other words, if the main reason for, the financial crisis was we had a 30% fall in house prices, and you had all these people who insisted that that wasn't possible. They should have realized it was possible, but they didn't think it was possible. Well, you're not going to make a living will that protects against events that you don't think are possible. So I think in all probability that at the end of the day, your living will is not going to protect you against a set of events that actually put you into insolvency. The last part of the story is, if we don't like government bureaucrats, think again about this process. So we have institutions that have living wills that in principle are reviewed by whichever regulatory body it might be. Well, do we really count on the regulators to be able to adequately review those living wills? If you don't have confidence in regulators, I don't think that's likely to end up very well. And sort of a good example from another sector, if you remember the BP spill in the Gulf last year, BP, of course, was supposed to have a cleanup plan. Do people remember BP's cleanup plan? Talked about how you deal with walruses, and I'm serious. That was their cleanup plan. It was a joke. Well, I think you're likely to end up with that situation that if you go the route of living wills, unless you have more confidence in regulators than I do, and I think probably many people here would, I think that the living wills will, in most cases, end up being a joke. And if you do actually end up with a bank or a financial institution that's facing insolvency, I think it's not likely to be of very much use. The resolution authority that you have in Dodd-Frank, I would say is better than the situation we had previously. So I guess I'd say given the option of resolution authority or no resolution authority, I'd take resolution authority. So in other words, if we have too big to fail banks, if we have, the Citigroups, the Bank of America that, are too big to fail, I think it's good to have resolution authority so that you could deal with something that's very unwieldy to deal with in a bankruptcy process. I think that would be positive. It would have been good had we had that in the fall of '08 when Lehman and AIG were facing bankruptcy. I think that would have been good to have that there. But again, it is very problematic, and I'm sure the other panelists will raise questions about that. It is very problematic because people don't know how different assets will be dealt with, and that creates the risk of exactly what you're trying to avoid, that you'll have a run on these institutions. So I'm glad, to my mind, it was positive that that was put into Dodd-Frank, but I don't think it gets around the big problems, and I think as a practical matter, I think, it's still the case that well, the Obama administration or any administration, any set of regulators will be very, very reluctant to go that route. We may get a test of that. I won't claim to be an expert on Bank of America's finances, but I think most people agree they're very much tottering. It will be very interesting to see whether they end up facing resolution. My guess is that they will not. Now, that might be because they aren't really insolvent. That may well be the case. But my guess is that even if they were insolvent, you would not see the regulators take the initiative to actually resolve Bank of America. Okay, well, the last part of the story, what do you do? And as I said, break them up, and I've suggested that in various contexts, and the inevitable response is, how would you break up Bank of America? How would you break up J.P. Morgan? And there's a simple answer to it. I wouldn't. I tell them to do it. This is very simple. All you do is give targets, whether it's done in percentage terms or dollar terms. You have to get your assets under X, $800 billion in 3 years. All your divisions, you have to be broken up into divisions that have assets or market shares of less than X in 3 years, less than Y in 5 years, 7 years. They break themselves up. J.P. Diamond, I'm sure, is a very smart guy. If he were given the task that he had to get every division of J.P. Morgan under $800 billion in 3 years or 5 years, whatever the time frame is, I'm sure he'd be able to find a way to do that maximized the value to shareholders. And then if he had a further target of $200 billion, say 10 years out, I'm sure he'd do that very well. So at the end of the day, this is not something that the government should impose on the banks in the sense of breaking them up into specific pieces. All they do is set targets and let the banks break themselves up. So what I would argue is if we believe in market capitalism, I think the way you want to go with too big to fail banks is to downsize them so that they're not too big to fail. We don't want the government subsidizing financial institutions. That's the situation we have now, and I don't think that's a good one. Thanks.
Mr. Singer.
I'm going to be talking about squeezing in 4 topics, basic topics. One is, I think, being a lawyer, a practitioner, I've been trading bankruptcies since 1984, providing some context about the markets, about what the financial system looks like, actually, and how it's evolved is important, and then creating a nexus. I want to create some context, discuss what should have been done, very briefly, discuss briefly what I think Dodd-Frank has done, and what's wrong with it. Context. You know, think back 30 and 40 years, most Wall Street firms were partnerships. The first public firm, going public transaction was just about 40 years ago. Banks were banks. What is a bank? Whole loans, reserve accounting, and this nexus with federally insured deposits, and a regulator that more or less, through thick and thin, kind of knew how to deal with actual banks and actual balance sheets. After May Day 1975, when fixed commissions, a big source of very predictable revenues, went away, traditional drivers of agency profits started diminishing. And it's hard to remember, but you have to. Prop trading, trading and investing on the asset side of diversified firms' balance sheets didn't really start until 30-ish years ago, in the government bond market gradually evolved. 20 years ago, very few of the firms were actually making trading, prop trading. And by the way, prop trading exists, even if it's called customer facilitation. This Volcker rule is nonsense, it's ridiculous. But trading and owning assets and having that be a big driver, and recently, in the last few years, the dominant driver, evolved over a period of time, and it didn't exist a time ago. So I want to talk about arithmetic for a second. I want to talk about the arithmetic of margin. When dinosaurs ruled the earth, you had to put up 50% for a stock, and you had to put up 30% for a corporate bond. Now, the arithmetic of 50% margin is very simple, and 50% margin was provided by broker-dealers who were watching the customers like hawks and had the following rules. You put up 50%, and if the stock declined 20%, you got a maintenance margin call. 20% because your equity went from 50 down to 30, and you had to put up some more money. Think of that number and then think of what a derivative actually is. All it is, it's not insurance. It's not insurance. A derivative is simply a contract mimicking the risk and reward of a particular asset. That's all it is. And over a period of time, the way firms margin derivatives contracts, which have the same risks as stocks, corporate debt, government debt, increasingly lax, increasingly liberal, for a lot of different reasons, including the moral hazard of the Greenspan put and growing arrogance for a number of different reasons. But you fast forward to just before, well, a few years before this crisis, and what do you find? You find that the largest financial institutions in the world are opaque and insanely leveraged. Let me tell you about a deep dive we did about a month ago. And we did it on Bank of America. And I'm not saying that because Bank of America is or is not solvent or insolvent or in trouble or not in trouble. We did it because we saw what was going on in the foreclosure lawsuits. It looked vulnerable, and it looked interesting and complicated, and my firm invests in bankruptcies and complicated securities. And so I set a team, and I have 115 investment professionals. I set a team to analyzing Bank of America. Here's what they came back with, and it was no surprise. Because I was looking for, well, you buy something here, and you hedge it there, and there's some kind of a snazzy complicated reason why that's better than that, and that's a great trade. Here's what they found. 150 billion-ish of equity, including preferred, $2 trillion of assets on the balance sheet. Okay, way more than we would be leveraged, but, and it's impossible to tell what those assets are. And part of it is a bank, and a whole bunch of it is goodwill, but, you know, sort of in line with the rest of the guys. But here's the problem. 75 trillion, that's with a T, trillion dollars, notionals, long and short, of derivatives. Now, I trade derivatives. I have relative value trades and quasi-arbitrages and all kinds of stuff. And I know what can happen to large derivatives trades that you think are going to oscillate like this, and you thought, wow, what a cool thing, I'll buy that and I'll short that, and it's a cool trade. And then in a crisis, advancing in every crisis, by the way, in amplitude, intensity, power, it doesn't trade like this, it trades like this. And of course, the reason you have these big trades is because you counted on something safe. $75 trillion takes that balance sheet and makes it, and the financial condition of Bank of America, and makes it completely and utterly opaque. You're probably saying to yourself, well, there must be something in the notes to the financial statement that gives you some clue as to the nature of those positions. Absolutely not. Absolutely not. I challenge anybody in the room, outside of the room, come tell me what that looks like from the standpoint of an outsider. Parenthetically, what we found out in 2008 is, from the standpoint of most of the insiders, they didn't understand what was on their own balance sheets. Stan O'Neill, Dick Fuld, Chuck Prince, you know, with billions and billions of this fake AAA stuff, which a couple of hours of conversation might have told them, wow, that's not really AAA, that is garbage, that has cliff effects galore. All housing prices have to do is level off, much less turn down. But okay, $75 trillion. Now what we know by knowing something about banks is a bunch of that, please excuse me for using technical terms, a bunch. A bunch is a very technical term on Wall Street. A bunch of it, and the reason I'm using the word a bunch is because you can't figure it out. A bunch of it is trades that are actually unwound, but you did $1 billion with Deutsche, and you did an offsetting trade a couple of weeks later because UBS had a better price. So you have counterparty risk, but you're long and short the same thing. And so that's kind of an unwind, but with counterparty risk. Also, you did a swap with some bank in some state, and you did an opposing swap with somebody else. You kept the risk on your balance sheet on both sides, but you basically have offsetting risks, exactly the same thing, except, again, for the counterparty risk. But of that $75 trillion, what proportion is actually trades the way Elliott Associates and 200 other hedge funds would know derivatives trades? Answer, you don't know. Okay, so in that sense, I have said, and it's true, that because of the opacity, because of the inability of GAAP accounting to actually tell you what's worth knowing about the balance sheet as a whole, including these derivatives, which are a lot of which are actual positions, you don't actually know at any point in time what the financial condition is of any of the large financial institutions. What that means is, when somebody gets into trouble, all you have is, hey Bob, did you hear about big bank X? Yeah, what do you think? I don't know, but I'm going to pull my assets. And that was the major lesson of 2008. You couldn't figure out in 2008, those, some of whom are on our side, who say, gee, people ought to do their due diligence. People ought to do their work. They ought to be encouraged to do their work, meaning their analysis. You can't do it. The information isn't there. Outsiders can't do it. And so you're in this realm where you don't know anything except, at the moment, you feel that the government is guaranteeing all of them. And that's the main reason why I agree with Dean Baker that in some fashion the survivors are survivors only because of the taxpayer guarantee, and in some fashion there ought not to be any institutions that are too big to fail, and they can be broken up in some way, and I don't have as clear an idea as Dean about how to do the breakup. But thinking about the speed of modern markets, the intensity of the way investors and people in today's communications world change their mind, the still extraordinarily high leverage. The balance sheet leverage has come down somewhat, but the overall leverage has not. It really hasn't. And it's also not able to be understood. Okay, so systemically important financial institutions, so-called SIFIs. It's a metaphysical and Talmudic quest. It's absurd. It's stupid. I know as a derivatives trader that any institution on the planet, given derivatives and the way things are margined to this day, can become systemically important, can unbecome systemically important in a short period of time, and most diabolically, a host of medium-sized institutions similarly situated can and will and do become rows of dominoes in certain kinds of markets and certain kinds of environments. The problem coming into Dodd-Frank is Dodd-Frank, what should have been done, and I think this is worth spending a couple of minutes on, because I feel it's pretty clear. There should have been a global collaboration up front before 2,000 pages or 1,000 pages or whatever it is of Dodd-Frank were passed. Global collaboration, because there's a race to the bottom. You have margin requirements and somebody else doesn't, and they'll all go to Singapore or Palau or Mozambique if they decide to be the center of the world. And global collaboration, G20, whatever, and barriers to going beyond, with the view of coming up with a sound financial system. And a sound financial system, anybody that says, no, we don't want any regulation, fine. Follow that to the end. No margin requirements for customers, no regulation. Well, a state of nature, it's crazy. Because it's most crazy because what you end up having, as we saw in 2008, a private reward and public risk. And that's asymmetrical, and most common people, not common people, but regular investors or citizens think of that as unfair, and it is unfair, private reward and public risk. So all forms of traded risk should be margined the same, whether they're stocks or equity derivatives, long or short, and regardless of the form of the entity and the regulatory status of the entity. The part of these big financial institutions that's not a regular whole loan bank is more or less indistinguishable from us. People look at us and monitor our credit. We lodge our assets at prime brokers, and whether it's UBS or Morgan Stanley or Goldman Sachs or any of them. They're looking at us to not provide risk to them. There is nobody really looking at the risk of their trading and their positions. And as I've told you, in looking at the overall footings of these firms, that portion of these firms constitute really the largest, by far, largest hedge funds on the planet. You can't tell how large because you can't figure out what that 75 trillion, and they all have trillions and trillions and trillions of derivatives. There also should be no end user exceptions. When somebody says, well, I have this gold mine or oil well, and I'm going to get this oil or the gold over a period of 10 years, and I'm going to sell a strip. What you do not have is a perfectly hedged position. What you do have is an unmatched trade, and the security part of it, the hedge part of it, should be marked to market. Otherwise, what you end up having is large unsecured debits coursing through the system. And in certain kinds of environments, a gigantic increase in the price of commodities or crash in the price of commodities or other things. That's, you can see the locus of the next crisis in looking at that. So I don't think it's appropriate to one more major element of what should have been done. All of these institutions could have easily been dealt with in bankruptcy. My firm is either the first or second largest holder of Lehman claims at the moment. We're the only hedge fund on the official creditors committee. This bankruptcy has been going along just fine. They filed with over a million derivatives trades. Here's the problem with Lehman and what made it, the sort of a ground zero of the most intense part of the financial crisis. The problem is the derivatives book. And within a few days, were it not for the global, basically global implicit and explicit government guarantee, most of the rest of the firms, and here's the one part that I agree with Ben Bernanke on what he said. He said 12 of the 13 major financial firms, he didn't say what the 13th was, JP Morgan thinks it's them, would have gone out of business in short order. I totally agree with that, not prejudging whether it was 12 or 5 or 6 or 7, but they would have. What you need to do is relatively straightforward, pending this deleveraging of the global system. Change the treatment of derivatives books. My guess is on the date of filing, the Lehman derivatives book was not insolvent, that the termination clauses of the ISDA contracts very skewed against the defaulting party, thought to be the hedge fund that Wall Street can pick over. It wasn't contemplated that it be the big Wall Street firm. And so what they did was, what you could do is extend the stay as long as mark-to-market payments were being made, hive off the derivatives book. Lehman would have had no systemic risk had that been done. And it wouldn't have taken that much money to continue mark-to-market payments, figure the rest out, put in some government money. There would have had to have been changes, no question about it, changes to accommodate the changes in markets and financial structures, capital structures over the last 20, 30, 40 years. But it wouldn't have brought down the world. There's a lot more to be said about this, but I see I've run over, so we can say it a little bit later. But I just want to make a couple of conclusions. I'll back them up a little bit later. But did Dodd-Frank create a safer system? No. Did they? It created a more brittle system because the FDIC, as I think Peter said, can seize companies that are in danger of default, not which have defaulted. Is ordered to throw out management immediately is preposterous. The whole process of throwing a company into the OLA is very truncated, a day or two. It's really unreviewable because of that truncation. They're enabled to discriminate among classes of creditors, and they can transfer assets willy-nilly to bridge institutions. What does that mean? And I'll leave you with this thought. Think of the trading desk, or the head of the trading desk, or head of the firm down the block, watching a firm get into trouble and reading Dodd-Frank. Here's what you say. I guarantee you say that because I run a firm and I know what we say when somebody gets into trouble. The lesson of 2008 and reading Dodd-Frank. Because you don't know how your claim is going to be treated compared to the claim of the SIFIs, JP Morgan or Citicorp or whoever else, may also hold claims and may also be a counterparty. You don't know how you'll be treated. So do not go out to lunch, do not go to the bathroom, pull your assets, stop trading, sell your claims. Anything else you do is to take the lessons of 2008 and throw them in the toilet. And so if you think about it, what OLA, what the orderly, ironically named Orderly Liquidation Authority, will do is create a much more intense and powerful effect than even 2008, a black hole in the next crisis. I do not look forward to if and when this procedure is contemplated or thought to be on the horizon.
Thank you for this opportunity. I'm going to disagree with a lot of what you've heard, so be alert. First, I want to make some distinctions, some lawyerly, I guess, distinctions. And one is that I'm not going to be talking about banks. A bank is a very special institution. A bank takes deposits, makes loans, it changes short-term liabilities, that is deposits, into long-term assets. That's its function. Banks are very unusual creatures, and they could be potentially too big to fail. But if you read the press, this distinction is not made. For example, the question was asked just a little while ago by Dean, how many of you would think Goldman Sachs should be allowed to fail, while he was talking about banks? Goldman Sachs is not a bank. Goldman Sachs was an investment bank, not a commercial bank. It did not take deposits. It was not regulated by a bank regulator. And I'm going to talk a little bit about Lehman Brothers, which is exactly the same as Goldman Sachs. It was not a bank, and it failed. And I'll talk about the consequences of that and why I think that's very significant. We also have a resolution authority already for banks. That's the FDIC for banks. Again, let me make clear, we're talking about the deposit-taking institution when I use the term bank. Everything else is a non-bank, and that could be a bank holding company. It could be an insurance holding company like AIG. It could be an insurance company or a hedge fund like Paul Singer's operation. Or it could be a finance company. I mentioned this all during my discussion of what the Dodd-Frank Act applies to, and that's what I will largely be talking about, these non-bank financial institutions. Now, the Dodd-Frank Act was based on the notion that large non-bank financial institutions called systemically important financial institutions, or SIFIs, are too big to fail. That was the going-in assumption. The theory, the reason why they are too big to fail, is that they are interconnected. This term dropped into media discussion of this issue as soon as the financial crisis arose. They're all, it was said by Bernanke and Paulson and many others who were involved in making these policy judgments, they are all interconnected with other financial firms, so that if a SIFI should fail, it will bring down these other firms, causing a systemic collapse of some kind. That's why the Act sets up this FSOC that I talked about before, the Financial Stability Oversight Council, to designate what these SIFIs are, because they're the ones who theoretically will bring down others if they fail. And it subjects them then to stringent Fed regulation, even though they're not banks. Now, the Fed today regulates banks, some banks, most big banks, and bank holding companies, but it does not regulate insurance companies, securities firms, finance companies, insurance holding companies, any of those. It only regulates bank holding companies and some banks. Okay, now if you are declared to be a SIFI, you are then turned over to regulation by the Fed. So the Fed would then be regulating all kinds of institutions other than banks or bank holding companies. It also sets up this orderly resolution authority for these SIFIs, and indeed for others. It's not just SIFIs. Any institution that is deemed to be a danger to the financial system when it fails can be put into this orderly resolution or liquidation system. Now, this is an important point. When Lehman failed, it did not drag down any other financial institution. With one exception, that was a rather minor exception but had consequences, and that was the reserve fund. The reserve fund, a money market mutual fund, had held on to some commercial paper that it was holding in Lehman, and so Lehman's failure caused a tremendous loss to the reserve fund. The reserve fund then broke the buck, and in the panicky situation that existed at that time, the reserve fund was then substantial problem and caused a run on other money market mutual funds. But the problem with the reserve fund, I'm sure, was a moral hazard, and that is after the rescue of Bear, almost everyone in the market thought the U.S. government's policy had been established. It was going to rescue every large financial institution, and so the managers of the reserve fund obviously said to themselves, well, why would we sell this Lehman paper if we're worried about it? Because if we just hold on to it, they'll be rescued anyway and we'll be paid in full. So that was a clear case of moral hazard, and that's one of the reasons why we had the problem in the mutual fund area. Now, let's turn to credit default swaps, because Lehman was a major player in credit default swaps. In addition, Lehman had a lot of credit default swaps written on it. A credit default swap basically says, and I don't want to get too deeply into this because eyes will glaze over so quickly that everyone will be having his head on his lap. A credit default swap basically says if a bond or other financial instrument fails, you pay someone else. The swap is one institution taking the risk that a second institution will not be able to meet its obligations, and as a result of that, the institution that is taking that risk has to pay off a third institution, the one that bought that kind of protection. Now remember, and this is extremely important, these numbers can sound astronomical, the $75 trillion that Paul was talking about, but these things do not pay off until there is an actual default. So if someone fails and can't meet its obligations, that is only a problem to its counterparties if this other instrument has also defaulted. So if A has bought a credit default swap from B, hoping that it is protecting itself against a failure by C, if B fails, A is in no worse shape. It has paid premiums for that swap, paid like a premium for an insurance company, for an insurance contract, but unless C fails, A has not lost what it bought protection for. So A goes back into the market and buys another credit default swap from someone who is not B. Okay, that means that the risks are wildly exaggerated in my view, and what happened in Lehman shows that. Because Lehman not only had credit default swaps written on it, that is, people who were afraid that Lehman would fail, but Lehman was also a major player in the credit default swap market and had probably trillions of dollars valuation of credit default swaps outstanding, in which it was a counterparty. So the credit default swaps on Lehman were settled 5 weeks later by an exchange of about $6 billion among several hundred counterparties. That settled all of the losses taken on Lehman because Lehman had failed. And then the question was, well, what kind of losses do we take in cases where Lehman was one of the counterparties? There were about 900,000 such contracts. Most of them were canceled immediately, which you can do. And of course, again, if Lehman has promised you that it would protect you against C, the loss of a loss on a bond issued by C, and Lehman has failed, what do? You haven't lost anything from C yet. You've just lost your protection, like your insurance company going broke. You go out and you buy another credit default swap to protect yourself against the loss on C. So all of the cases where people needed this protection, they canceled their contracts with Lehman. They went and bought other credit default swaps for whatever protection they needed. And for those that were in the money, that is, at the time of the failure, Lehman actually owed them some money on some losses that had been made. They became they became creditors of the bankrupt estate. All very simple. Now, the important point here is that nobody failed as a result of Lehman's failure. There were several institutions that got into serious trouble and failed or were rescued: Wachovia, Washington Mutual, Merrill Lynch, AIG. They were all in some way or another rescued or saved by the U.S. government, but they did not fail because they suffered losses as a result of Lehman. How do we know that? We know that because the losses that they suffered, when you look at what happened to them, were caused by a meltdown, what was called the mortgage meltdown, when about $2 trillion in assets became, which were mortgage-backed securities, based on usually subprime or other very weak loans, when those $2 trillion in assets became almost worthless because of the fact that the market for mortgage-backed securities simply disappeared. Now, this is known to scholars as a common shock. When a large number of financial firms are in trouble because of a decline in a widely held asset. In this case, the problems were exacerbated by something called mark-to-market accounting, in which financial institutions were required to value their assets at the market price, and since there was no market, the value of these assets were written down hugely, and also by the moral hazard that was flowing from the rescue of Bear Stearns. After Bear Stearns, as I suggested before, people assumed that Lehman would be rescued. When it was not rescued, everyone was thrown into chaos. Logically so, because if you expected that there wouldn't be any losses anywhere, and you thought that the large institutions that you've been dealing with would be rescued, then you're not going to worry too much about what happens. And that was actually shown by the credit default swap market, which is a pretty good market in risk, and it was fairly steady up until, from the time Bear Stearns failed, was rescued rather, up until the weekend before Lehman failed. The weekend that Lehman failed, just before the weekend, the credit default swap market really just broke open. The potential losses were thought to be huge. And so that's where you had the blowout. But the fact that there was this sudden shock to the market is what created the chaos, not the fact that losses were going to be suffered by institutions that had been dealing with Lehman. So, the fact that Lehman had no significant knock-on effects means one thing to me. This $600 billion institution, it was a huge company. This $600 billion institution was not too big to fail because it did not drag down anyone else. And this is especially robust evidence, in my view, because Lehman failed at a time when, as I suggested, virtually all other financial institutions were in trouble because of the common shock that I referred to. So everyone was weak. Lehman fails, yet no one else fails as a result of that. Now, some people will say, well, wait a minute, they didn't fail, and this is what, oddly enough, Bernanke and Paulson and others have said, they didn't fail because government interceded quickly and prevented things from happening. Well, it didn't, actually. That's another part of the myth. The government did have the TARP program. The TARP program actually didn't make any funds available to the large institutions who we are really worried about, the ones that would be dragged down, didn't make that money available for 6 weeks after Lehman's failure. And then, with the Fed's approval, that money was paid back in about 8 months after Lehman's failure. So if there was really a hole in the balance sheets of these very large institutions because of Lehman's failure, the Fed wouldn't have allowed these funds to be paid back. So they weren't really put there for that purpose. They were put there to calm the market, give the market some confidence that everyone was not going to fail. The same thing is true of the various guarantees that the FDIC placed on borrowings or lendings by large companies, large banks. The purpose, again, was not to fill any holes in their balance sheets as a result of losses on Lehman, but rather to give people confidence in dealing with them because no one was actually sure who was solvent and who was not. So Lehman's failure and the fact that it did not drag down others with it demonstrates some very important things. The interconnection theory that I mentioned at the beginning is wrong. Lehman, as I suggested, was not too big to fail, which means, to my mind, that non-bank financial institutions of any size, and Lehman was one of the biggest, and Goldman Sachs would be another, are not too big to fail. There is no need for the FSOC and its power to declare certain institutions as financially important, that is SIFIs, and there is no need for any special resolution authority for any of these institutions because they can simply be sent to bankruptcy, as they would have been before the adoption of the Dodd-Frank Act. Now that's the lesson to me of Lehman's failure, that we didn't need a Dodd-Frank Act to address the serious problems that were seen in the financial system or prevent another financial crisis. The right policy would have been to try to put into place ways of looking at the financial system so we can address what I call the common shock. If we can stop common shocks, then we could stop the sort of thing that happened in the crisis of 2008. Do I have any more time?
You do, if there's something else you'd like to say, because Mr. Cohen is not yet here.
He's not? Okay, I'm taking some of Raj Cohen's time, sorry. But I'm delighted by the opportunity. I just want to talk about a few things. You won't be as educated by me as you will be by Raj, but I'll do my best. I want to say a few things about what Dean Baker said, because these are really important facts. Break up too big to fail financial institutions. Now, Dean was talking about banks again, and I do agree that it could be that large banks are too big to fail because of the nature of the bank and what people use banks for. No one puts his payroll with Lehman Brothers or Goldman Sachs. People put their payrolls with banks. And if a bank fails, there is a lot of ripple through the economy. So, banks are different. But Dean says, let's break them up. And I say, to what size? Because the problem is we do not know what size would keep the government officials from deciding that the failure of the institution will bring down the financial system. When the Continental Illinois Bank defaulted or was in danger of default in 1984, it was $40 billion. And it was considered too big to fail by the government officials because they are terrified of chaos and the things that might result when a large financial institution fails. So I don't know that there is a number that we can say, oh, well, $800 billion is the number, or $200 billion is the number. Who knows? And we don't know what we will be losing by requiring institutions to reduce their sizes to that number. Glass-Steagall, I want to mention Glass-Steagall, talked about all the time by people who say, well, we ought to go back to Glass-Steagall. Dean mentioned this. Glass-Steagall still applies to banks. Let me repeat that. Glass-Steagall has not been repealed for banks. Banks still are subject to restrictions on whether they can engage in the kinds of activities that were forbidden by Glass-Steagall. What happened in 1999 was that a portion of Glass-Steagall was repealed, that is, the portion that said a bank cannot be affiliated with a company that is principally engaged in underwriting and dealing in securities. So that meant bank holding companies could acquire securities firms and hold both a securities firm and a bank. That's all that happened in 1999. If we look at what happened in 2008, if Glass-Steagall had still been in effect, the same thing would have happened. Goldman Sachs and the others, which were not banks, could have been acquired by bank holding companies. They were not. The banks and the investment banks both got into the same problem, holding these mortgage-backed securities that were based on very poor quality mortgages, and had nothing to do with whether or not Glass-Steagall was still in effect. It could have still been in effect, and the securities firms like Goldman Sachs and Lehman and Bear Stearns would have gotten into trouble, and the banks would have gotten into trouble. Glass-Steagall is irrelevant to this discussion, but it still keeps coming back as though somehow it permitted something that made a difference in 2008. The lowest cost of funds, absolutely agree with Dean on this, and this is the danger of the whole SIFI idea. Because if the government declares through this FSOC that certain non-bank financial institutions are SIFIs, it is saying they are too big to fail. And if it says that, they, like Fannie Mae and Freddie Mac and the banks that Dean mentioned, will have huge advantages over smaller institutions. And I suggest that are competing with them now. And I suggest that this will change the entire nature of our financial system. So if there is anything, and I'll leave you with this, if there is anything in the Dodd-Frank Act that demands, in my view, immediate repeal, I think the entire act should be repealed, but the thing that demands immediate repeal is the power of the FSOC to declare certain non-bank financial institutions as systemically important and thus too big to fail. This could change our financial system in hugely important ways and make it much less competitive. These large institutions will be able to drive smaller competitors that aren't able to get the same credit advances at the same cost out of business, out of their markets, as Fannie and Freddie did for the same reason with any competitor in the secondary mortgage market. Thank you very much.
All right. Our discussion thus far has been a little bit lopsided because we have had 3 critiques of Dodd-Frank, albeit from very different perspectives, and no defense of Dodd-Frank. That was to be Mr. Cohen's role, and he is not here to do that. And I am going to decline to take on that role. I'm just the moderator. So, Peter has already launched into his response to our other panelists, and I'd like to give the other 2 of you an opportunity to respond to what your fellow panelists have said before we throw it open to questions.
Okay,
Mr. Baker.
I'll just say a couple things on responding to the points Peter had raised. I think it's a little quick to say that there were no repercussions from Lehman. I mean, again, primary reserve, we could say that it was bad judgment and everything, but the point was primary reserve, I don't know if it was the largest, but certainly one of the largest money market funds would have faced very serious problems. They broke the buck. How bad that would have been, we don't know, because the government did intervene. And just to remind people, these were very, very serious interventions. The government guaranteed all money in money market mutual funds. That's a really big deal. I mean, these were not supposed to be guaranteed by the government. So that was a really, really big deal. What would have happened after that, I don't know. We immediately doubled or more than doubled, we raised from 100 to 250 the insurance amount for deposits in banks, again, a really big deal. And then on top of that, we insured an unlimited amount of money in non-interest-bearing accounts. So these were really, really big deals. At that point, there was a run on Merrill Lynch, which was stopped when it was taken over by Bank of America, which, you know, depending whose side you believe, whether it was engineered by the Fed or whatever, but in any case, there clearly was a run that probably would have ended up in their insolvency absent the takeover. And again, same with Goldman Sachs and Morgan Stanley, that were allowed to become bank holding companies with the protection of the Fed and FDIC. Otherwise, they too almost certainly would have faced extinction. Now, what was the immediate kickoff, again, it wasn't directly Lehman. We went from a regime where it was understood that the government would protect too big to fail institutions with the perception that Lehman was one of them, to a regime where suddenly people thought they could fail. So how do we think about Lehman in that context? Well, it wasn't immediately that, it wasn't that Goldman had holdings with Lehman. I'm sure they had some connections, but that wasn't the main story. It was suddenly the fear that these institutions actually could fail, and then the government had to turn around and very quickly say, no, they can't. We are going to stand behind them. So I think Lehman, again, to say that it had no secondary implications, again, we saw primary reserve. There might well have been others, that was stemmed by government action. I'm not in a position to say whether there would have been other major failures, but primary reserve is certainly a very big one. Getting back to Glass-Steagall, and again, Peter's right that Glass-Steagall only referred to banks, but there's a peculiar story here. So you go, okay, fine, we're segregating the banks from the bank holding companies. The bank holding companies could engage in trading, could have hedge funds, whatever it might be, insurance, The argument, though, is that we're keeping a strict separation. And here's where I have the problem. If we're keeping a strict separation between the bank itself, which has insured deposits, and the other activities, which could be much more speculative, then what's the economic rationale of the merger? The argument was they're going to have one-stop shopping, so you can go to your bank and buy insurance and say, well, you could do that anyhow. There's nothing to stop a bank from contracting with an insurance company to have a window in the same, that makes no sense. So if there's really a strict separation, then there's no economic rationale for the merger. And again, just think market, think government. Here you have a financial institution, a complex financial institution. They're promising us that there's a strict separation. So you're confident the government regulators are going to enforce that? I'm not. So that's my argument on that. And again, Peter's right. I don't see. A lot of my friends have been anxious to blame the repeal of Glass-Steagall for the crisis. I don't see it. I mean, I've gone through everything I could on there. I'd be happy to blame if I thought it was true. I don't. So I think that part is true, but that doesn't mean that doesn't create problems that, even though they didn't manifest themselves in a big way in this particular crisis, that they wouldn't show up in other contexts.
Mr. Singer.
Couple of things. In the days immediately following Lehman, everyone in the marketplace, everyone running assets knew, because of their own planned behavior as well as their observations around them, that within a short period of time, Morgan Stanley and then Goldman Sachs were going out of business. As soon as Lehman went bankrupt, that feeling was replaced by a widespread belief that the government would not allow any other major financial institution to actually go out of business. It is that comfort, not, as Peter says, not reduced to actual cash for quite a while. That guarantee, that implicit guarantee, that belief in the marketplace that kept the rest of the financial system from unraveling, it's crystal clear to everyone who traded the markets and had assets that they were about to push the trigger to move in the ensuing days. If there's one thing that I can provide as a service to at least this segment of humanity, it's a deeper understanding of derivatives. And I have some proofs, and if there's any member of the Nobel Prize Committee in the room, I'll be putting in my application form for these proofs. But let's talk about CDS for a second. I think the way Peter described them was unduly mechanistic. It is true that the way the contract is written, it's a contract about getting paid and default of the underlying credit. But what it actually is and mimics, almost to the inch in normal markets, is the actual underlying credits of the same duration. And the proof of that is basis trading. And in all markets until the summer of '08, the basis, that is to say the actual interest rate differential between credit default swaps, and the underlying credit were measured in 5 and 10 basis points a year. When it got to 20 basis points a year difference, trading desks started to load up when it got to 50 and 80. I would just say that in the midst of the crisis, the basis went crazy because it wasn't going to be closed up for another 4 or 5 years by the actual expiration of the contracts. And when I say going crazy, it went out to 800 and 900 basis points differential. But they are treated as the same, and they are the same. What happens to the credit happens to the CDS in almost all markets within an inch of each other. Sovereign debt. Here's the smoking gun, and here's the proof that mark-to-market accounting is absolutely essential. European sovereign debt. The actual trading prices of debt, we all know, as well as CDS, reflect some kind of credit spread, which reflects some kind of probabilistic assessment of insolvency. Let's not forget that Greece and Italy, let's take Greece. Just a year ago or so, the credit spread went to 200 basis points or 300 basis points. Now, at a time when interest rates were very, very low, that's not a really high yield for 5-year debt. But as time went on, that credit spread has gone to, thousands of basis points, and now most people think that Greece is going to actually default. Treating Greek debt like a light switch, that is to say, oh, we're not changing the price, we're not marking it to market, we're not telling you what our books actually look like when the trading prices are taken into account. When you combine that with the opacity that is unchallengeable, the opacity of these financial institutions, you get a situation which is completely unacceptable. If I think at least that companies with some kind of a lag are marking their books to market, then at least I have some shot of having something close to an actual a read on equity and profit and loss. If I know that gigantic swatches of their actual financial condition are not marked to market, then the opacity and the leverage become even more intense. The last thing I want to say is, this government guarantee, which stemmed the last collapse, needs to be thought of today in the context of the United States and Europe in different forms for somewhat the same but somewhat different reasons. The sovereigns are called into question. The last line of defense, the last line of barbed wire before they come into the tents and into the sleeping bags, metaphorically speaking, is under question. And so it's a matter of urgency, in my view, at a time when, at the moment, U.S. sovereign debt, 30-year bonds trading kind of under 3, Euro sovereign bonds, 30 years, traded at 2.5 yesterday, maybe 2.55, something like that. It's a matter of urgency to address these notions of leverage, opacity, the actual resolution of some of these problems. Dodd-Frank went in exactly the wrong direction. So I agree with Peter's actual conclusion, but disagree with much of what kind of leads up to it.
All right. Any further rebuttal?
Yeah, if I can just have a minute or two. We have to put all this into some kind of context, and it's very important to remember what happened in 2008. In March of 2008, Bear Stearns, that was the least large, the smallest of the big investment banks, was rescued with a payment by the Fed with J.P. Morgan Chase to acquire Bear Stearns. That, to my mind, was the original sin. That suggested to the market, gave a very clear signal to the market that things were different from then on. These large financial institutions like Bear Stearns would be rescued. As a result of that, people did not raise the kind of capital that they should have begun raising at that time. And there were many, many other changes. I mentioned only the one that happened to the primary reserve fund. But every institution in the market took steps or didn't take steps, like raising capital, that it should have taken under the circumstances when Bear Stearns was rescued. Now, I just don't happen to believe that if Bear Stearns, and we'll never know the answer to this, but I happen to believe that if Bear Stearns had been allowed to fail, there would have been some disruption in the market, but it would not have been a financial crisis. And then everyone would have responded, that is, Bear Stearns would have gone to bankruptcy, just like Lehman went to bankruptcy, and everyone then would have understood where things were, and more capital would have been raised, and other things would have been done in order to protect against the possibility that some other institution would fail, and then those other institutions like Lehman probably wouldn't have failed because they would have taken those necessary actions. Okay, that's why it is very hard to go back now to 2008 and say, well, all these other firms were in trouble after Lehman failed. And one of the reasons they were in trouble is because they didn't actually expect that Lehman would be allowed to fail. And so they hadn't taken the kinds of precautions that they would have taken if Bear Stearns had not been rescued. Let me just go on for one more minute on this question of mark-to-market. I'm kind of agnostic on the mark-to-market idea. Might be okay. It's certainly okay for trading institutions like Bear Stearns or Goldman Sachs. Their assets should be mark-to-market. But the important point in this particular case was because of common shock, because the market was so stunned by the unprecedented number of mortgage failures that were occurring in the United States, the market disappeared. There was no market. And when Paul is talking about the credit default swap market, where spreads have widened substantially, that's a real market where people are actually betting one way or another about whether a company is going to fail or not, and if what they can earn if the company doesn't fail. All that's fine. That's a real market. There was no market for private mortgage-backed securities by the end of 2007 and the beginning of 2008. In that case, applying woodenly this idea of marking assets to market was foolish, crazy. It made all of these institutions look much weaker than they were, because when you write down almost $2 trillion in assets to almost nothing on the balance sheets of financial institutions around the world, you reduce their capital enormously. And so, of course, investors were frightened. They were worried about whether these institutions were stable or insolvent or not. That was a crazy thing to do, and we allowed the SEC and the accounting profession to run this whole thing through without making any changes or allowances for the reality of the situation. That's one of the things that was most serious in causing this financial crisis.
All right, the last word, Paul.
I need to respond to one part of that. It's just not the case that there was no market. Through 2007, what we saw was the big firms being very slow, let me be as gentle as possible on this, very slow to reflect the accurate prices. There was a market for every one of these securities. The investment banks just didn't like the prices. They just didn't like the prices. And it was as hard to buy the stuff at the prices that were actually prevalent in the market as to sell the stuff. So there was illiquidity, but there was a market in all of this stuff at all times. And a very interesting point about those prices that prevailed in that time, a whole lot of them have actually not recovered, because they actually presaged and were the preview of the actual defaults in the ensuing year or two. Let's not forget, in 2008, the actual foreclosures had scarcely gotten underway. The actual losses in the mortgage pools had actually not started. So it was all price action trying to predict, and pretty accurately predicting, the collapse in the subprime CDOs.
All right, Dean, the very last word.
Very, very quickly, just, the underlying assets here, of course, were mortgages, and you could look on the FDIC at failed banks like IndyMac, and some may have done this systematically. I just eyeballed them, but a lot of those were selling for like 30 cents on the dollar. So if your market price was somewhere near 30 cents, that might well have reflected the underlying assets pretty well.
All right, we have time for a few questions. We do have people on both sides of the audience. If you would just raise your hand, they will come to you. And while you are identifying yourselves, I will ask the first, with some trepidation, however, and it is concerning the extent to which anything in the Dodd-Frank regime is subject to judicial review. It's my understanding that there are some very significant jurisdiction-stripping provisions in Dodd-Frank that severely limit the role of the courts in reviewing any of FSOC's SIFI designations or the designation of a firm as a candidate for an OLA, and I apologize for these acronyms. If Frank Easterbrook were here, he would have my head, but anyway, that's the new world that we're living in the ordinary course, in a bankruptcy, a conventional bankruptcy, or even other forms of liquidation like receiverships, the process is judicially supervised, which at least contains some protections for the rights of stakeholders, and this regime does not. Mr. Cohen is here, and perhaps he's the one to speak to that. But I'll let you catch your breath for a minute. Peter, you had a response to that question.
Yeah, well, there is a right to challenge the SIFI designation, and it's kind of an ordinary right. I don't remember many restrictions. The one that is peculiar and is stunning to me is that the Congress said that when the Secretary of the Treasury has decided that an institution is about to fail and should be put into the orderly resolution process at the FDIC, first of all, the assumption is that this will be secret. Nobody will know about this. The institution then has a chance to go to court to prevent that from happening, that is, to claim that it is actually solvent and is not going to fail. The court has 1 day to make that decision. And if they don't make any decision, then it is assumed that the Secretary of the Treasury is correct.
Well, there you have it. That's the extent of the judicial review, which either has my colleagues in the federal judiciary, some of whom I see here today, breathing a sigh of relief, or not. Anyway, Mr. Cohen, you've had a chance to catch your breath now. We have had no one on this panel thus far defend Dodd-Frank, and that role falls to you. I did introduce you at the top of our session today, and so I'll skip a reintroduction. It was a very nice introduction, by the way, so...
Thank you.
Go ahead.
Please, and I really do apologize for being here so late. I certainly know that the one industry which is hated more than the banking industry, although in this case it's justifiable, is the airline industry. If there is any issue relating to the financial crisis of 2008, on which I imagine there is widespread agreement, it would be that the resolution process was woefully inadequate for our largest institutions. And the 4 key inadequacies were when the government did decide to provide special financial support, and it did for 4 major financial institutions. It exposed the taxpayer to risk of loss and explicitly confirmed too big to fail with all the decided disadvantages. Second, when the government failed to provide financial support for another large institution, Lehman, it precipitated financial contagion with systemic consequences. Third, there was no specialized resolution process for large financial institutions beyond ad hoc solutions, usually accomplished within the space of 48 hours, which is not a good decision-making process. And fourth, there was inadequate information on which to base a resolution. So Dodd-Frank was designed to respond to each of these inadequacies with a new resolution regime. And a critical premise of this new resolution regime is that it would be available only under very special circumstances, one of which must be a serious adverse effect on financial stability in the U.S. banking system. Otherwise, it's bankruptcy. Now, there are procedural safeguards to assure that an institution will not be just on the whim placed in this specialized situation. First, you've got to have a recommendation by the Fed and the FDIC, each by a 2/3 vote of the board. Then there must be a determination by the Secretary of the Treasury, and then there is congressional review. I agree fully with Peter that the after the fact challenge is basically meaningless, but there are some safeguards going in. So as the judge said, I suspected I would be the only one here to try and defend Dodd-Frank. It's not perfect, but perfect is always the enemy of the good, and let me try and explain why I think it dealt with these four inadequacies. I'll do this very briefly in view of the time. And I also recognize that I have a heavy burden of proof, not only because of my distinguished co-panelists, but trying to justify any act of Congress creates that burden of proof. But I do think Congress got it right. Let's deal first with the key, which is too big to fail. Now, again, I think we will all agree that ending too big to fail is an essential element of any acceptable resolution regime. It creates competitive unfairness and distortions as smaller institutions can't fund on the same terms. Too big to fail also has a now demonstrated element of moral hazard. If bank creditors consider themselves protected by the government, they will not exercise discipline and will enable financial institutions to take outsized risk. Moreover, and I think this is a different perspective, I would argue that even from the perspective of the nation's largest banks, continuation of too big to fail would have a profoundly negative impact. Because if too big to fail is not eliminated, there will inevitably be demands for a very different regulatory approach for the largest banks. Either they will be broken up or they will be made subject to a utility-type regulation model that reduces the probability of failure. In addition, expansion would be tightly limited so that banks could not grow further. Now, here's why I maintain that Title II has substantially, if not totally, eliminated too big to fail. I just don't really know what more Congress could have or should have done. In the event that an institution goes into this special resolution regime, its shareholders are wiped out, its management is replaced, and its creditors are held responsible for any losses. Moreover, unlike the bankruptcy code, which has the possibility of rehabilitation under Chapter 11, here there is no option to liquidation. I don't know what else could be involved in the definition of failure. One more key element of Dodd-Frank is that it bars the Federal Reserve from using a special lending authority that had come in the early 90s to benefit a single institution. And that had been the critical weapon which had been used for many of these rescues. With respect to the second inadequacy, Title II creates a resolution regime that should reduce the systemic consequences of the failure of a large financial institution and thereby makes it a viable option. There can be prompt payment to creditors at estimated recovery rates. There can be a bridge company which will enable the FDIC to stabilize the institution and enable it to be sold, recapitalized, or wound down in a more orderly way. Liquidity support is available from the Treasury. Creditors, importantly, are assured of a recovery no less than they would have received in a Chapter 7 bankruptcy, and importantly, a number of key bankruptcy code provisions are adopted which will avoid a rush to the exits. Third inadequacy, now you have a regime. Fourth inadequacy, through the living will process, you now have the information which is necessary. Let me try lastly to respond to the argument that none of this really ends too big to fail. It is maintained that if a major financial institution again is in jeopardy, Congress will have no choice but to ride to the rescue with a bailout. I can't deny this possibility, but today, at least, I find it unlikely that you could find 51 senators or 218 House members who are willing to chance political suicide by voting for a bailout. It is also important to note that this argument inherently presumes that no congressional action can really end too big to fail, nor can simply leaving institutions to the prolonged agonies of the bankruptcy code. And I know the time is short, so I'll end with that.
Thank you very much. And we do have time for a few questions. We've just had our time extended by a few minutes, so to accommodate questions.
I have a question here.
Right here, there you go.
Is the microphone on? I'll
Yes.
speak up. Peter Wallison made the case that there didn't seem to be a lot of reason that we could not go to bankruptcy with these large institutions. And it occurs to me that he makes a persuasive case, and if so, why is there such a to-do about the too big to fail? And now these too big to fail banks, so-called, are all primary dealers for the U.S. Treasury. And in a time in which we're borrowing 40 cents of every dollar that the federal government is spending, it's understandable that Fed officials and Treasury officials would be very, very concerned about the maintenance and continuation of the ability to place these securities with the primary dealers on their way to ultimate customers, unfortunately consisting in part of the Chinese and of the Federal Reserve balance sheet. But is it perhaps then the case that what's really going on with too big to fail is actually a understandable fear on the part of Treasury and Fed officials that this mechanism by which we are maintaining this regime of extreme fiscal irresponsibility is what is at stake? And I appreciate any comments on that.
Go ahead, Peter. Go
You
ahead.
want to do that?
I think
something to say.
certainly one of the considerations would be if there was a freezing of all the primary dealers. I think any one primary dealer would not be a problem. The number just went down by one a week ago, but there's still, I think, 17 or 18. But I think it's that is an element, but it's part of an overall contagion fear.
I would just add one thing, and that is, I think, you mentioned the term fear on the part of the government officials, and I think that is an overriding factor in all of this. If you think about it, if a government official rescues a failed institution, he or she is a hero, not only to the creditors of that institution, but to everyone who is afraid that there would be chaos if this institution failed. But if you allow the institution to fail, and chaos results, you're a goat. So the tendency of government officials generally, and that's why I mentioned the case of the Continental Illinois Bank, a $40 billion bank that was regarded as too big to fail. Granted, it was 1984, which everything was smaller then, but that is a really good case for the proposition that these powers to take over institutions and send them to some sort of special resolution process is a bad idea, because the government will use it again and again.
Just
Paul
to
Singer.
quickly, oh, sorry, you can go first.
I agree with the premise of the question. Just a comment first, and that is, you use the word primary dealer. The only primary dealer today in U.S. government debt is the Federal Reserve Board, which has been buying just about 100% of all of the long-term issuance of debt. So these other people are standing around getting agency commissions for basically doing nothing. But on your main point, small changes in the bankruptcy law that would make the unwind of a very big derivatives book less chaotic, plus a Treasury line of credit, would be all that is needed to deal with while the big institutions are deleveraging, to deal with the next insolvency or two. The notion that it has to be handled by this seizing companies in danger of default, not even that have defaulted, in a 2-day process, ordering them to throw out management, ordering the FDIC, which knows nothing about these complicated non-banks, to toss out management. We get a giggle every time we think about that. Can you try to imagine throwing out the entire management and having Sheila Baer's successor and a few people at the FDIC running these multi-trillion-dollar institutions? It's preposterous. Dodd-Frank, we'll only know the first time it's used, but we feel very, very pessimistic about the cascading effect of the use of Dodd-Frank and the fear of Dodd-Frank. This law enshrines too big to fail. It doesn't eliminate it. The way it does it is that as a company is thrown into this procedure, the SIFIs around it will be perceived as too big to fail, and everyone else will know that they are the suckers, the stuckees, and all of that will create what I've termed a black hole effect.
Dean Baker.
Just a couple things. Peter's raised Continental Bank a few times. I just think it is important. He had mentioned this. This was 28 years ago. $40 billion was, I think, about 1.5% GDP at that time. So it'd be around 250, 300 billion. It's not as big as our, J.P. Morgan, the really big, too big to fail banks, but it wasn't a trivial sized bank. The other point, just to remind people, the reason why the court process, the appeal process here in the resolution case is so short is because obviously this has to be done very quickly, very secretively. The way the FDIC typically operates when they resolve a bank, they come there Friday evening and then everything's set up by Monday morning. Now, again, if it's not a good process, you don't want to do it. But if you're going to do it, it does have to look like that. Otherwise, it becomes a joke.
All right, did we have a question on this side of the room?
Right here? In the center?
There, in the middle.
Real quick question. Isn't the real problem here, though, or part of the problem, and hasn't been addressed yet, the accounting rules and just the straitjacket effect of the accounting rules that exist for banks? I mean, there's really no clear disclosure. I mean, Mr. Singer made the point that he's done a deep dive on $75 trillion worth of notional derivatives and notional value derivatives, and doesn't really know how much of those would be sort of matched against each other and what the real risk is there. One would think that if the securities laws were designed to actually show the condition of a company, of the securities issuer, that somebody in the accounting profession or the securities profession, I guess present company accepted, would try at least to make some sort of disclosure. We've got $75 trillion worth of notional derivatives, but actually 65 trillion is matched, and the effect could be as much as $500 billion if everything were to go to hell in a handbasket. It seems like we've gotten away from any kind of good securities disclosure in this area. And to the Continental Illinois point, I mean, Continental Illinois couldn't disclose that it was holding all the Penn Square derivatives underneath it that caused that failure.
Okay.
So, I mean, isn't that just a constant problem we've had for the last 25, 30 years?
Comment on that?
The problem that you just raised is exacerbated and made much more intense by the leverage. If the leverage wasn't so high, it wouldn't be so poignant to understand not just what the assets are, but the sensitivity of those assets. A lot of derivatives are very opaque, and so the disclosure, in order to be fair disclosure, would have to be sensitivity to changes in curve shape and currency relationships and the dimensions of risk. No financial statements today that I'm aware of contain a lot of information about that.
Final thoughts?
One thing I might add, and that is in the derivatives industry, the rule of thumb is that the actual exposure is about 2.5% of the notional amount. So a notional amount of $100 trillion would be $2.5 trillion. The reason for that is some of the things I mentioned in my remarks, but that is the way things generally have been working out when there have been some losses. And so I think it's not if we look at what practically has happened, rather than the theoretical things that might happen under certain very unusual circumstances, the disclosures that are made by the banks and others engaged in this business are not that far, are not as bad as Paul Singer was saying. But he's in the business, and I'm just a lawyer.
All right, go ahead, final thought.
Could I just offer one further comment? I think the focus on derivatives is appropriate. I think there is one particular derivative that remains a ticking time bomb in the financial services industry, and it is the credit default swap. And my problem, I agree, for a number of institutions, disclosure is not everything it should be and could be improved. My bigger problem is I don't think the regulators around the world still have a handle on who has written the CDS, who has the CDS, and exactly even what the terms are. I mean, there was the big debate when the banks agreed to the 50% haircut on Greek debt. They thought they were insured. No, ISDA said, sorry, that is actually not a default, so the insurance isn't there.
All right, we're going to have to leave it there, and let's thank our panel.